Most people spend their entire lives trying to get out of debt. They pay off their credit cards as fast as they can, they celebrate burning their mortgage, they wear debt-free like a badge of honor they've earned. And on the surface, that makes complete sense. Debt feels dangerous. It feels like a weight you carry everywhere you go, a chain around your ankle that keeps you from moving forward freely. But here's the thing nobody tells you. The wealthiest people in the world don't think about debt that way at all. They don't avoid it. They use it deliberately, strategically, and often very aggressively. And that single difference in mindset is one of the biggest reasons the wealth gap keeps widening year after year. It's not that rich people simply earn more and save more. It's that they've figured out how to make borrowed money work harder than earned money ever could on its own. Think about that for a moment. The same dollar doing more work, generating more return, simply because of how it was sourced and deployed. That's what this video is really about. Not convincing you to go rack up credit card debt or take out loans you can't afford, but showing you exactly how the wealthy think about leverage, why it works so powerfully, and what rules they follow to make sure it never blows up in their faces. Let's start with the most important mindset shift you need to make. There are two kinds of debt in the world, and most people never learn to tell them apart. The first kind takes money out of your pocket every single month and gives you absolutely nothing back in return. That's a car loan on a depreciating vehicle. That's credit card interest on a vacation you already forgot about. That's buying furniture on financing or upgrading your phone on a payment plan. That is consumer debt. And yes, that kind is absolutely a trap. The wealthy avoid consumer debt just as aggressively as anyone else, if not more so. But the second kind of debt is completely different. It's debt that puts money into your pocket every month or steadily builds an asset that grows in value over time. That's leverage. And the wealthy have known for generations that if you borrow money at a lower rate than the return you're generating on the asset, you come out ahead every single time. The math is disarmingly simple. If you borrow at 5% and your investment returns 10%, you pocket the difference. You are essentially using the bank's money to make yourself richer. That is not reckless. That is not gambling. That is not luck. That is how wealth compounds faster than most people ever believe is possible. And it has been hiding in plain sight for anyone willing to look at debt just a little differently than they were taught to growing up. Now let's talk about how the wealthy actually put this into practice, because it's not theoretical and it's not reserved for billionaires. The most common and most accessible form of leverage most people will ever use is a mortgage. And here's the problem. Most people don't think of their mortgage as a wealth-building tool. They think of it as a burden to eliminate as fast as humanly possible. But consider what's actually happening when you use leverage in real estate. When you put 20% down on a property and that property goes up 10% in value, you haven't made 10% on your money, you've made 50% on your down payment. That is the power of leverage working directly in your favor. And the wealthy don't stop at one property. They use the equity built in the first to fund the down payment on the second, and the second to fund the third. They're not doing this recklessly. The rent covers the mortgage, the taxes, the maintenance, and ideally leaves cash flow remaining every single month. The debt is entirely self-funding. That's the key distinction that most people miss completely. The asset pays for the leverage. They never have to reach into their own pocket to service the loan, and over time, they end up owning a growing portfolio of appreciating assets they never could have accumulated with saved cash alone. Beyond real estate, there's a strategy the ultra-wealthy use that most everyday investors have never even heard of. It's called a Securities-Backed Line of Credit, or SBLOC. Here's how it works. Instead of selling their investments to access cash, which would trigger capital gains taxes and pull money permanently out of the market, they simply borrow against the value of their portfolio. The investments stay fully invested, continue compounding, and the loan provides liquidity whenever they need it. Interest rates on these loans are typically low because the portfolio itself serves as collateral. And in many cases, borrowing against assets is not a taxable event at all. So the wealthy can access millions in liquidity, pay a relatively low interest rate, and never once disrupt the compounding growth of their underlying investments. This is exactly why you hear about billionaires who report surprisingly low taxable income year after year. They're not living on a salary. They're living on loans backed by assets that never stop growing. It sounds like a loophole, and in some ways, it genuinely is. But it's completely legal, and it becomes more accessible than most people realize once your investment portfolio reaches a meaningful size. The strategy is elegant in its simplicity, and once you truly understand how it works, you cannot look at wealth or debt the same way ever again. This is not a trick. It is a system, and systems can be learned. Then there's business leverage, which is where some of the most extraordinary wealth creation in all of history has taken place. Every major company you can name was built at least in part with other people's money. Venture capital, bank loans, corporate bonds, revolving lines of credit. Businesses use debt as fuel to grow far faster than their own cash flow would ever allow. And the logic is exactly the same as in real estate. If borrowing $1 million at 6% allows you to generate $3 million in revenue, the math works overwhelmingly in your favor. Entrepreneurs understand this intuitively. The goal is never to build slowly, using only what you personally have saved over time. The goal is to deploy capital as efficiently as possible, and borrowed capital is just another form of capital. Even small business owners apply this principle every single day when they take out a loan to purchase new equipment, hire additional staff, or expand into a new location. The debt accelerates the business forward. Without it, growth is slower, competition catches up, and opportunity windows close before you're ever ready to step through them. The wealthy don't sit around waiting until they've saved enough. They calculate the return, validate the risk, and move with leverage when the numbers make sense. So why doesn't everyone do this? Why don't more people use leverage the way wealthy people do? A big part of the answer is fear, and that fear is not entirely irrational. Leverage amplifies losses just as powerfully as it amplifies gains, and there's no getting around that reality. A property that drops in value while you're highly leveraged can leave you owing more than the asset is worth. A margin loan during a steep market downturn can trigger a forced sale at exactly the worst possible moment. These are real risks, and the wealthy take them seriously. But they manage those risks with strict, non-negotiable rules. They only borrow to acquire assets that appreciate in value or generate consistent cash flow, ideally both at the same time. They make sure the asset can fully service the debt on its own, so they're never dangerously exposed if their personal income takes an unexpected hit. And they always build in a meaningful margin of safety, stress testing their numbers against realistic worst-case scenarios: rising interest rates, falling asset prices, vacant units, slow revenue quarters. If the answer is, "I'm uncomfortable but I survive," the leverage is sound. If the answer is, "I'm completely wiped out," they simply don't move forward. That single discipline is the entire difference between leverage that steadily builds generational wealth and leverage that quietly destroys everything you've worked so hard for. The difference between the wealthy and everyone else isn't access to money. It's the willingness to understand how money works and the discipline to use it by a set of rules that protect the downside while capturing the upside. The wealthy don't have a secret. They simply have a different relationship with borrowed money and a clear set of rules that keep it working hard in their favor year after year. And now, so do you. For more exciting videos like this, follow Wealth Narrate. Comments below, what do you think about leverage?